Growth stocks up, the Dow down, Tesla pounding 22% to the upside. Hey everyone, Dave Keller here, and welcome to Chart This with Dave Keller, our daily market recap show. Great to be joining you from here in a beautifully sunny Redmond, Washington. Thanks for joining me every weekday after the close, and especially today, Thursday, October 24th, as we do our best to make sense of these markets using the lenses of technical analysis and behavioral finance. Technical analysis is all about how you understand the world around you using price action, using the message the markets are providing back to us in the form of price, breadth, sentiment, trend, momentum, all things we can measure, all things we can quantify, and all things we can evaluate and particularly recognize when the evidence changes. We also like to hint at some behavioral concepts. I like to talk about my style of investing as behavioral investing, combining behavioral finance, what happens between our ears, and technical analysis, how we can make sense of the world around us. And I found that combining those two can provide some meaningful outcomes for your state of mind and especially for your portfolio. And I hope on the show we're able to provide a little of both. Just as a quick reminder, I'm live streaming now on YouTube, on Twitter, X, LinkedIn, and Facebook. Thanks so much for joining me wherever you're viewing this. I can see your comments, whatever platform you're on. Just drop a comment where it's available. And later in the show, time permitting, I'll grab a question or two to answer before we end the live stream. Anything we don't get to, we'll go into the Chart This mailbag. We are planning an all mailbag episode tomorrow on Friday. Great way to wrap the week. Great thing to review over the weekend. Kind of take a step back, think about lessons learned, and how you can maybe get a jump on the week to come. With that in mind, let's get to our market recap and look at how things have played out today. There we go. Actually, I want to start with a poll question. I actually asked you guys, and sorry, I thought I had the poll up, but I did not. Here we go. I asked on the Twitters, on X, I asked earlier today, will the S&P 500 finish the week above or below key trend line support? Now, if you've been watching the show, that trend line is that blue dash trend line we'll see in a little bit. That's the low from August and September. Lines up pretty well with where we're at yesterday and today, right? Sort of right around that level. And the question was, are we going to continue below or above? Now, to be clear, this is more of a fun question. This is more to get a sense of where people are at, where their head is at in terms of their current positioning, because people usually vote with what they think hope will happen because of how they're positioned. I don't think there's a lot of value necessarily in predicting where Friday's close will be, but I would say thinking about a potential outcome based on the trends and analysis that you've done up until this moment, I don't have a problem with that. What was interesting as I asked this question, almost a coin flip, a perfect tie between above or below. So if it feels like there's a little bit of uncertainty and a little bit of insecurity about what may be next, for what it's worth, I'm kind of seeing that same thing as I'm surveying my own audience and trying to get a sense of where they're at. Think about that one, by the way. I'm wondering what all of you would say in response to that poll question. All right, with that in mind, let's get to the market recap here and look at how the markets played out. Big update for Tesla, right? Up over 20% after earnings yesterday. Certainly investors taking the announcements and the earnings call with a very positive light. That is certainly helping the NASDAQ lead the way higher. The NASDAQ composite up almost 0.8% to 18,415 and change. The S&P 500 closed just below 5810, and that's up 0.2% from yesterday. The Dow is actually down slightly, down about 1/3%. You can see mid caps and small caps both up slightly, not a huge up day. And the NASDAQ composite was the best performer out of that group. And the NASDAQ 100, by the way, at the top, and that's obviously dominated by those mega cap growth stocks with 4 letters in their ticker. The VIX actually earlier in the day was up above 20. What's funny is I sent out a tweet right around here saying, all right, VIX just pushed above 20. Of course, that was it. That was the moment. I top ticked the VIX today, apparently, because we rotated back down. And that's an important lesson, right? I mean, as I often remind you, and hopefully, is that intraday moves are just temporary, right? That in a lot of ways is kind of noise. The close, right? There's a reason why we look at the closing price. There's a reason why we wait for the close to lock in technical indicators. There's a reason why I wait for Friday's close to lock in any changes to my market trend model, because between any sort of open and any sort of close, there's some fluctuation. The close versus yesterday's close and versus today's open. Now that is a legitimate comparison that you can make, because there's a point we started and there's a point we ended, right? There was an open to trading, there was a close to trading. That is a directional move. So, recognizing that there can be all sorts of, movements to the upside and downside during the trading day. But at the end of the day, what progress did we make? And for the S&P 500, right? I mean, it kind of choppy and we ended slightly higher. For the VIX, couple days now, we've pushed above 20 intraday, but by the close, we're actually back below there. And for me, that's meaningful because 20 is kind of the level, right? Below 20 means low volatility environment, not too much to worry about. VIX above 20 means maybe something to be concerned about, primarily because pretty much every major pullback that I've experienced in my career involves an increase in volatility. And it goes back to, market maxims about how markets trade. I was taught by one of my mentors, Ralph Acampora, markets go up the escalator and down the elevator. That's why a chart has a certain look, because shares are accumulating, they trend higher, then they come down pretty quickly. And that's because when people start to get nervous, they don't sort of calmly and rationally start to pepper in some sell orders. They panic sell, and that causes a waterfall decline as selling begets further selling. And all of a sudden, that's why things go up slowly and then come down very quickly. That's also why if you flip a normal chart upside down, it kind of looks a little off. And that's because uptrends and downtrends have a particular feel. So the more you look at charts, the more you'll recognize when something's not quite right with the charts, like flipping the y-axis. All right. Going to interest rates, rates have been trending higher here recently. Yesterday kind of chopped around. The 10-year yield finished the day yesterday just above like 4.25, almost right around 4.25 yesterday. Today back down just below 4.2%. That's on the 10-year point. The long bond yield pulled back just slightly below 4.5%. And the 5-year yield remaining just slightly above 4%. So that trend in higher rates has been, basically bond markets selling off. This is more about the market pricing in or sort of changing expectations about the trajectory for rate cuts, a little less belief or a little lower confidence that the Fed would be as aggressive as I think was priced in earlier in the year. This basically has represented that investors are perceiving maybe a slower rate cut cycle. For now, though, a bit against that, right? You see interest rates actually coming down slightly. And I think that's important because a lot of the home builders had looked incredibly strong. They kind of chopped around recently with rates spiking back higher. If rates can remain low, that would be certainly be a good tailwind for certain groups. Home builders come to mind. Think of any sort of consumer business that involves consumers borrowing money to purchase something expensive. That's what lower rates would probably help. The TLT, which is a bond ETF that we track, Treasury bond ETF, up about 0.2%. The dollar down about 0.3% from yesterday's close. Kind of mixed results here in the commodity space. You can see sort of a weird move for the DBC. That's a broad commodity ETF. It's more geared toward energy than anything else, but you can see the DBC actually opened much higher, but traded lower by the lunchtime hour, was actually net down of the day, actually finished essentially unchanged, but it was a noisy session in the first couple hours. Gold continues its relentless incline. I've had a lot of really great comments and questions and thoughtful feedback, along with some other stuff, more spammy comments with my conversation recently with Peter Schiff. It's fun. On my podcast, I really enjoy talking with people like Peter, and really, a lot of people doing a lot of different things. I never treat conversations like that as gospel, right? I'm not saying by having Peter or any of the people I've had on a podcast or show that I've hosted, it's never to say, here's something I agree with. You guys should all listen to this person. It's more to make you think. And that is the point of what I do with the show, with Market Misbehavior, with my premium memberships. It's all about just encouraging you to spread, sort of shift your thinking and reconsider things that you assume and present alternative points of view just to help you question your own in a healthy way. And that's what I thought my conversation with Peter was really interesting about. And the reason why I'm bringing it up now, we not surprisingly talked about gold. He's pretty bulled up on the gold space. And we talked about gold versus dollars and what's a good store of value and why. For what it's worth, gold continuing that uptrend. So as stocks sold off a little bit in parts of the equity market, gold actually pushing higher by about 0.75%. Silver, not as much. Silver actually finished slightly in the red. Crude oil actually down today. Cryptocurrencies almost all in the green today. You can see Bitcoin actually bottomed out just above 65,000. That was yesterday. Now we've had a nice sort of incline over the last 24 hours or so, 12 to 24 hours, giving Bitcoin a bounce up to just above 68,000. Ether prices around 25.30, and most of the rest of the top cryptocurrencies on the stock charts platform in the green today. All right, the big move in terms of sectors is the XLY. And what you have to remember when you see a thing like this, I think a lot of people, a lot of investors kind of just getting started, more novice investors that aren't really familiar with what these sector ETFs are really measuring. They see the XLY up 3% and they think, okay, wow, consumer stocks were up a lot. Not necessarily, right? These ETFs having big moves are often less about the sector having a move, but more one big name can dominate an ETF like this, and a big bounce in a big name like a Tesla, which is what we experienced today with Tesla up over 20%. It doesn't matter if every other consumer discretionary stock was slightly down. The XLY might be still up a little bit because Tesla is a pretty big weight. It's one of the top 3 stocks in the ETF, and it was up a ton. I mean, that's a pretty unusual upswing for any sort of mega cap stock for sure. So the XLY leading higher, that's really a Tesla story. Some others obviously doing fine, but I think that's more of a Tesla than anything. We'll see that in a little more detail on the heat map today. Communication services and tech are your next two. Those are both up about 1/3%. So we're back to offense over defense, at least today. Growth at the top of the list. XLY, XLC, XLK, your top 3 performers. On the bottom, we have some cyclical sectors. Materials, the XLB was down about 1.25%. You got some negative movements in gold miners and others popping to the downside. Industrials, XLI, and healthcare and really utilities all down about 2/3% today. You know, I don't formally change my market trend model until Friday's close, but just as a quick heads up, the my main market trend model, which is that top line based on the S&P, remains bullish on all time frames, getting a bit of a warning sign on mid caps and small caps, with both of those potentially turning negative on the short-term time frame. Now, again, I don't formally change this model until Friday after the close. The good people at Stock Charts have this checked at the end of the trading day after the close, sort of runs a check just to see if the model changes at all, but it's really more of a placeholder until Friday's close when I would formally change anything. So for what it's now based on, or for what it's worth now, so far with 4 of the 5 days now locked in, we're seeing enough of a short-term pullback. The main market trend model looks like it would still remain bullish, but the short-term model for mid caps and small caps moving slightly lower. That might be something important to certainly follow here going forward. All right, let's look at the Magnificent Seven and Friends. Tesla, of course, the big story today, up 22%. There's not a lot of economic data floating around these days. It's really more about earnings, I would say. And then we're going to sort of wrap earnings season and go right into elections and then the Fed meeting. So November, most likely going to be a pretty busy month market-wise. But for now, it's about earnings, and Tesla's earnings call was crucial. That gap lower that we saw after the robo-taxi event hurt pretty bad in terms of the technical configuration. That gap lower really changed the configuration. With today's move higher and that gap higher really changes the configuration of the chart completely. We'll look at that chart in a little while and talk about some of the technical implications of the big rise like we saw today. Amazon was number 2, up about 0.9%. You can see a bunch of others, a number of others were up slightly. Only 2 of these were just basically flat for the day, Apple and Alphabet, slightly lower. But for the most part, the Mag 7 kind of did okay today. All right. Looking at the old heat map here, this is the MarketCarpet functionality on stock charts. I love heat map visualizations like this. I've done some videos on that. I think on stock charts earlier this week on Monday. If you go to the Stock Charts TV YouTube channel, I did a video particularly on the heat map that I'm showing you here called the MarketCarpet. Talked about 3 ways that I use that, and use that day's heat map to talk about some of the ways that you can use this to visualize a large number of stocks in a limited amount of real estate. Now, I'll tell you 3 quick takeaways, that is, looking at this visualization today. Number 1, high-level impressions. What's your view? I mean, to be honest with you, this is sort of a yawner, kind of snoozer of a day. You can see that there's, certainly some things that moved a lot, but generally speaking, I'm seeing like neutral, kind of that tan beigeish color as sort of the dominant color on the heat map today. So this feels like a day that most likely was not a big mover, particularly noticing the larger boxes like Alphabet and Microsoft and Apple essentially unchanged. So most likely this is a market that didn't move much today. In terms of other observations, I would just say, generally speaking, more negative than average in industrials and healthcare. And that's, healthcare at times it's sort of been feast or famine. I feel like with healthcare, there've been points in the year where it's looked very, very strong. And then there are points like this where all of a sudden it feels like it's dramatically underperforming. It's one of the worst places to be. Noticing in particular names like HCA, TMO, Danaher, Zoetis, Boston Scientific, all pretty bright red on there. So obviously some individual names having a bit of a downward move. Second thing we look at are the largest names, what I call the big dogs. Tesla's big up move obviously jumps right off the page of me, along with a couple of other these that obviously outperformed, but the rest of these really were more neutral and didn't really have a lot of upside movement. Other mega cap names to focus on: T-Mobile and IBM both jump out. T-Mobile with a nice upswing after earnings, and IBM gapping lower. And that would be it. And then the final thing would be looking at individual stocks that stand out. S&P Global, SPGI, is one that comes up. SPGI is an interesting chart because it's been such a strong chart for quite some time here. Let's actually go there next, and then we'll get into the chart review portion of the show. As a reminder, I can see comments that you're making on whatever platform you're watching this on. Again, I appreciate you tuning in from wherever you're at and whatever platform you're using. It's great to be able to live stream here in the modern technology age to so many people and places. I would tell you, as a reminder, any questions that you have, please pop them in the comments wherever you're at. I'll get to a couple here at the end of the show, and anything I don't get to, we'll put into the mailbag. S&P Global is a good one to start at, and I would say because SPGI is an example of, I think, a concerning development that we could see. I have a thing called the Market Top Checklist. I've done webcasts on this before. My Market Misbehavior premium members, and if you want information on that, go to marketmisbehavior.com, click on Become a Member in the upper right. We talk often about the checklist when the conditions suggest it, and certainly at our next weekly report, which will be over this weekend, we'll spend some time talking about that Market Top Checklist. Because while I can't say for sure the top is in, because I don't know, I will tell you I'm seeing some concerning developments. One of the 7 items on my Market Top Checklist is a proliferation of bearish divergences. This is when the market keeps going higher, but more and more stocks are doing that on weaker momentum. What does it mean on SPGI when it's making a higher high from mid-September to mid-October, but the RSI is sloping downwards? And the answer is it doesn't mean anything good. What that implies is that even though the trend is still positive, and even though we're making a new high about a week ago, we're doing it on way weaker momentum. And often at the end of a bullish run, you'll still be going higher, but the momentum will weaken. And that's because there's some distribution that's happening as investors are selling into strength, right? In a healthy bull move, investors are accumulating strength, right? You break out, investors are accumulating more. An example of that would be like in mid-July, right? We're breaking to a new 52-week high. The momentum is lights out positive. The volume at this point, I'm not showing here, was pretty encouraging. That tells you we're in a period of accumulation. Now look what happens later in the phase. We're making new highs, but on much weaker momentum, right? An RSI of around 85 here and around 62 here. So that difference is really the change in the configuration. A lot of times that can be a great leading indicator of the market sort of leaning a little too far over its skis. And sure enough, the gap lower today on SPGI takes us below the 50-day moving average. It's a gap below the October low. The RSI is now pushing below 40, and that divergence looks like a pretty good sort of leading indicator that something might not be right. I'm just going to pop that on the list so I don't forget that we talked about it. All right, continue on here with the chart list. This chart list. I better come up with a better name for that because that's a word jumble. Here's that blue trend line that I asked about in the poll earlier, right? We talked about how the major lows in August and September line up pretty well with the action that we're seeing this week. And this is where, as I mentioned on yesterday's show, once is twice, once is chance, twice is coincidence, 3 times is a pattern. That's how I was taught trend lines. One of my mentors would say that. And the idea of that is You connect 2 points, and if it independently connects with a third point later, that just validates that whatever you were drawing at the beginning, yes, that is definitely the right trend line because the market keeps testing it. And the more and more you test a trend line, it's like every time you test it, it further validates that that's an important level. And that's something that I use for trend lines like this. I also use it for traditional support and resistance levels. I found that to be pretty valuable as well. So it means a lot to me. I think that the S&P is now testing that trend line this week. And again, as we've talked about, in an uptrend, as long as we keep making higher highs and higher lows, the trend is fine. Which means if we break below that trend line, that could be the initial warning sign that this beautiful uptrend we've been experiencing, at least off of the August lows, may be changing, right? What we call a change of character. Again, the line in the sand, the really important level for me is around 5650. That would mean if we get below 5650, we've basically failed to hold any of those support levels, which means we find support right around here. This is just yet another pullback within a nice low volatility uptrend that has been the story for pretty much the entirety of 2024. We break 5650, we'll have to talk a little bit more about further downside projections, about risk management, getting defensive, taking bets off, all of those fun things that happen when the market's not going up anymore. It's sentiment day here. Every Thursday, we get the weekly sentiment data. There are a couple surveys that I like to track pretty closely. We'll talk about the AAII survey here. Next, we'll talk about the NAAIM exposure index, both kind of addressing, surveys asking investors sort of what they're thinking about the markets, but different cohorts, meaning different audiences that participate. This first one is really focused on individual investors. The AAII, American Association of Individual Investors, is a group of individual investors, obviously. I think average participant, sort of a retirement age, investing their own portfolio, actively managing to some degree their wealth. And so it's a good way of seeing what this group, sort of what this large cohort of investors and represented by this survey of participants, what they're seeing. I can't help but notice the last 2 weeks now we've gone down every week in terms of the percent of bulls. A couple of weeks ago, we were it's almost around 50%. We were right just slightly below 50%. It was like 49% and change when we did the show 2 weeks ago. Last week, slightly down. Today, we're actually the lowest level we've seen since April, which is actually this pullback right about here. The number of bulls versus bears, or at least the percentages as reflected in these numbers, very, very close to the zero level. That's what this bottom series is showing you, right? The number of percent of bulls minus the percent of bears. So zero means we're even bulls and bears. The last time we've been there was actually this low in April. So in an extended bullish phase, when you get sort of this pullback, a lot of times you'll get this number going back to around zero. And often that will be the sign of like the next bounce higher. But if we start to get big moves below zero, meaning bears outnumber bulls, that doesn't happen that often. And when it does, certainly in a bull market, when it does, that usually suggests that there's more of a topping phase that's at work here. Again, look at what happened in 2021, where most of the time was spent above current levels, right? Sort of in the 40 to 50% bulls. All of a sudden that started to change really in like August and then September of that year. We sort of had a pullback where the bulls got down quite a bit to around 25%. We had one more move higher, and then that was actually the peak. And then for most of 2022, the percent of bulls were much lower, and bears outnumbered bulls that whole time. So we're looking for that kind of rotation. Still early days to say that that's happening, but the bulls coming down week over week can be one of those warning signs that maybe things are getting a little less optimistic than they were before. The NAAIM exposure index actually came off a little bit this week as well, currently sitting around 79%. This is a survey of money managers asking them how they're positioned, what their exposure is to equity. 79% is honestly about as close to an average, like a mean, in my experience using the indicator. Usually 75 to 80% is kind of what I generally think of as the average. So we're right kind of there. Now that's down from over 100%, which was at the beginning of July. Overheated values are when we get above 100%. That's why I have that red line here. We really haven't had that sort of extreme positioning in quite some time. So what that means here, one way to think of it is, even though we've made new all-time highs here in October, that's on much less optimism that we saw in July, at least from the professional investors in that survey. This is a really interesting chart. I just want to make sure I mention this. And again, this came out of my conversation with Peter Schiff. Make sure you check out that podcast, by the way, on my YouTube channel. our new Market Misbehavior podcast. In my discussion with Peter, we talked a lot about gold and hard assets versus paper assets. This is a chart that I've actually spoken to a number of people about in the last couple months. This on the top is the NASDAQ 100 in dollar terms. And the bottom, this is the NASDAQ 100 in gold terms. You can do that easily by just dividing the price of the Qs versus the GLD or some gold index. Don't worry as much about the value, but just the direction and where we're at relative to where we've been. Even though the NASDAQ 100 is essentially testing all-time highs, the reason why it doesn't feel so good is because this is the NASDAQ 100 in gold terms. We're actually at the lower levels of what we've experienced in 2024. That gap is why the market does not feel as good as you think it should, with the NASDAQ testing new all-time highs. In gold terms, in hard asset terms, we're lower than we were last couple months. All right, let's talk about Tesla. On yesterday's show, we did talk about this chart. It was, I think, the last chart we talked about before taking a couple questions. You can see this gap, which was the robo-taxi gap, as I think we'll call it, the 50-day moving average right there. What happened today is we gapped higher. Now, this creates a pattern called the island reversal. The island reversal is a technical pattern where we gap lower, we kind of have some action, and then we gap higher. And so that's like think of it like you're looking overhead down on a map, and there's this little island sticking away from the rest of the action. This is a bullish island reversal where you gap lower and then we gap higher. It's pretty bullish. Here's the problem, though. We've gapped higher 20-some% today, but right up into overhead resistance. This is the December 23 high. This is the July 24 high. This is the late September high, and it's right about where we're at. So as much as this gap is impressive, as much as I would say this certainly in the short term suggests optimism, my question is, do we finish the week above that resistance? Do Tesla investors finally get a validation of the price making a new 52-week high, which it has not done in a long, long time? So still an open question. Overall, the gap higher, that island reversal is constructive, but I would say at this point, it's about, do we get above resistance? So if you miss that gap, I would personally be patient to wait for us to complete a valid breakout above well-established resistance. For an example of the kind of breakout you might want to hope for on a chart would be Kroger. I wrote an article for CNBC earlier today. If you subscribe to CNBC Pro, you can read it in all its detail. We talked about a cup and handle pattern, a cup with handle. Kroger is actually featuring a cup and handle inside a much larger cup and handle on the weekly chart. But I would say the break above 57, really 58, would complete it. We didn't quite get the validation because we had a big up day yesterday, but today it actually repelled that breakout. So I would say still waiting to confirm that cup and handle. But if you can clear that rim of the cup, that suggests much further upside for the grocery conglomerate Kroger. IBM gapping lower. A couple names really quick that gapped lower today on earnings. IBM gapping lower, that's not great. And the concern, I think the bear scenario coming through earnings season is companies like IBM disappoint, even though they've had really strong trends going into mid-October. There's a gap lower that all of a sudden causes investors to really question the sustainability of the uptrend because valuations have become so extreme. IBM, not necessarily the biggest valuation I could outline for you right now. And I would say we've now traded down to an ascending 50-day moving average, also the swing low in early October. So for me, just glancing at the chart, I would say this still is remaining above kind of that natural stop around 215. We break below there tomorrow. If buyers don't come in tomorrow, buying in on the weakness we experienced today, I think that suggests further downside on a key name. Newmont Mining, biggest gold miner listed in the U.S., down pretty big today, about 15%. Again, the challenge with Newmont is it's been a beautiful, absolutely impeccable chart until today. Now, this shows you, I think, the risk that we all take on by investing in individual stocks. If you want the potential for amazing returns, you also have to shoulder the risk of potential downside gaps based on what's called company risk or earnings risk. The idea that an individual company can have a problem and all of a sudden that individual stock gaps lower. And again, the benefits that we experience on the upside come with some downside potential, and that's what we're experiencing on a day like today. The bad news for Newmont is that does take us below the 50-day, does take us below the swing low. So for me, I don't have a position in Newmont, but if I did, I would have been stopped out with that break below 52, just generalizing based on what I'm seeing. Everything about this speaks to further weakness. Again, a bounce tomorrow might completely change the configuration, but for now, I would be much happier waiting, resetting, and reassessing once we find some sign of accumulation. Tractor Supply Company, another one gapping lower, down over 6% today, again, breaking the 50-day moving average. So a lot of these charts that had looked really, really good up until mid-October starting to change. If you're thinking about the breadth indicators, right? We talked yesterday about the percent of stocks above their 50-day moving average. Talked about how that was diverging. Every one of these tractor supply companies that failed to hold its 50-day moving average basically is another potential move lower, or the reason why those breadth indicators are getting weaker. That, for me, is a bit of a concern. I can't finish on that negative a note, so let's rapid fire go through a couple bullish charts, and then I'll take a question or two. Molina Healthcare gapping higher. We talked about this stock because it had gapped lower. All of a sudden, just like Tesla, bit of an island reversal. This is a bullish development. What concerns me about what happened today, though, is we opened around 323. We traded all the way up to like 342. But by the close, we're right back more in the lower half of the day. So that's not a great look today, right? That tells you that there was a lot of buying, but by the close, we're kind of back down toward the lows of the day. I think tomorrow would be really important. Anytime you have a big gap, it's all about the next day. You get that validation that that's not the end of the move. Final chart, and then I'll take a question or two. West Pharmaceuticals. And again, I'm a little bit skeptical. If we take this one and look at the candle chart, you'll find that there's this gap higher, but this is what's called a shooting star candle. That's when you have a big gap higher, not necessarily a gap higher, but you have a open, you trade much higher, but by the close, you're actually back toward the lows of the day. That often indicates distribution during the trading day. This is what I'm talking about here, right? So we gapped higher here, which initially seems really good. We traded all the way up above 350. But look how by the close, we're back at the lows. And all of that happened through the 200-day moving average. So we opened, we traded way above the 200-day, but by the close, we're actually back below it. That short-term distribution, think of it like an inverted V, tells you the next 1 to 3 bars are more likely lower. So this actually feels like a stock gapping up into a key resistance level and a failure to get enough buyers to propel the price higher. So I would say skeptical of this upside gap that we saw with West Pharmaceuticals. All right, let's take a question or two. Here we go. Bevan, I believe. I'm sorry if I mispronounced your first name. Hi, Dave. On the Stock Charts platform, I've been looking at seasonality, and it appears November, December tend to be strong months. How much do you factor seasonality in years past to your current trading? Really thoughtful question. Thanks so much for asking about that. So there is a seasonality tool on Stock Charts. I think it's a great, a great way of just kind of summarizing general conditions using seasonal trends. I'm going to zoom in just a little bit so we can see it pretty well. So what this does is if you bring it up and switch the top from sharp chart to seasonality, you can bring up this kind of visualization. What you need to do is type in the ticker that you want and then bring in whatever data that you like. So what I like to do is start off with bringing as much data as possible. 20 years is the maximum. And I just put it back 1 year. So I'm ignoring this year, which is not finished yet. So I'm basically saying from 2004 through the end of 2023, what's your batting average for each of these months? And to your point, November and December actually tend to be quite strong. 80% of the time, November has been a bullish month in the last 20 years, 70% of the time for December. If you look at the average return, the mean return, you can see November's up on average about 2.5%. That is the top month out of the 12. You could do it just on election years if you want to make it a little more granular. But to your point, absolutely right. Now, what does that mean for 2024? So I would say seasonality for me is not the main tool that I would use. I would never ignore the markets and say, well, November is a strong month, so I'm going to buy. I don't care what's happening. For me, seasonality provides the backdrop. And even people like Jeff Hirsch, who he runs the Stock Traders Almanac. His father, Yale Hirsch, is credited with popularizing seasonal trends and seasonality on Wall Street. And Jeff's continued Yale's, incredibly unique work. And I would say, even if you talk with Jeff, he would say, look, seasonality tells you sort of the playbook, but you have to pay attention to the current market. So he actually has a trend overlay to the seasonal tendencies. So what does this mean? This means almost all the time, November and December are pretty strong. We often have a fourth quarter rally. If you just look back at recent years, you're going to see plenty of times where that kind of happens. I'm looking at the weekly chart. Let me zoom out a little bit so we can see it. Yeah, I'm looking at the weekly chart here for the last 7 years. We're basically talking about November and December, pretty strong in 2020, pretty strong in 2021, even 22, which was a pretty down year. November, December actually held up okay. Last year, 23, November, December were pretty good. So, it usually is positive. Now, if you go back a little bit, you will find that that's not always the case, right? 2018, Q4 was actually kind of rough. 2015, Q4 was actually kind of rough and led into a really weak first quarter of the year, the next year. So there's no guarantee that the market is going to provide the seasonal trends, but it does tell me that if we do get a major sell-off, kind of 2018 style, it's possible, but it's just not very likely. The more common outcome is that you have a major low in kind of September, October, and then you rally higher. So one of the reasons why I would bring the seasonality into question in 2024 is because seasonal trends have not worked particularly well, right? In an election year, the first quarter is usually a little weaker than average. Q1 was actually incredibly strong in 2024. You usually have a really strong kind of July, August, and July was actually probably the biggest pullback of the year. So 2024 has been kind of a weird year, which you have to remember, there have been a lot of other sort of extenuating circumstances, geopolitical risk, a very contentious election compared to others where they've been less contentious, although I feel like they're all contentious these days. A Fed rate cut cycle and inflationary pressures, all these things are a little different. So that means, to summarize, I think seasonal tendencies are important, but I'm much more focused on the trends that I'm seeing and let the market tell you if November is going to be strong. The charts are going to tell you whether or not there's a position of strength or cause for concern. I think some of the things we've outlined on the show here suggest more a cause of concern than anything else. Folks, that is a wrap for the show. I want to thank you so much for joining me every weekday after the close for Chart This. Thanks so much for wherever you're streaming from. You can see all of our previous episodes on our YouTube channel. And don't forget to check out our new podcast called Market Misbehavior. 5 episodes, 6 episodes coming soon as I release my conversations with Adrian Day, Mark Skousen, and others. So a lot of great conversations to share with you, and I hope you enjoy. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great night, folks.